Good afternoon. Please can I ask you to take your seats?
Good afternoon, everyone. Hope everyone had a great lunch, but hopefully not too great so that we don't have to throw things at you to keep your eyes open, right? So fine balance. So welcome back to the concurrent sessions. Thanks for our lunch sponsor, which is Sapiens. And remember that we'll be doing Q&A after this presentation, and information is also available on the app. We're going to talk retirement and specifically talking about exploring hybrid annuities, behavior tax, and whether the choice of annuity affects this tax. And I'm going to hand over to Martinez Barnard. Over to you.
Hello everyone. I just want to check. Oh, the laser's not working, but in any case, doesn't matter. So I hope each and every one of you had a cup of coffee just now. Okay? Thank you. Now, it's not for you to stay awake, it's for you to help in my argument. So be honest with yourself, with your colleagues, with everyone here in the room. Please participate. I want to ask a question. How many cups of coffee have you had today? 1 or 2? 0. Did you start at 0? No, we don't start at 0 yet. 3 or 4? 5 or 6? More than 6? Okay, close enough. They say, there's actually a doctor that said it. They say you can have 6 cups of coffee in a day, and it's actually good for you. But you need to have it black, unsweetened, and not within 90 minutes from waking. Okay, that's number one. The second thing that they say is when you travel, keep a 3-second distance between you and the car in front of you, especially in the morning if you didn't have your cup of coffee. All right, and the last thing, this is just applicable to you, those of you that have kids, is it's not 6, 7, I don't know if you've heard it. You need to have 7 to 9 hours of sleep every night. Okay, now each of those principles are a rule of thumb. General guideline, it's not perfect. But today I want to talk about a rule of thumb. I want to talk about exploring hybrid annuities, behavior tax, and how your choice of annuity affects behavior tax. Now let's start off with a rule of thumb. It's a general principle that is correct most of the time, or that's roughly correct. Now my dad would say, plus minus naaste my ongeveer. It's like plus minus around approximately. Now that's a good approximation there for a rule of thumb. I'm not going to talk about that. I want to talk about a rule of thumb that's going to affect every single one of us. And that rule of thumb is the retirement income rule of thumb. Now it goes like this. It says that if you want a living annuity income that lasts and keeps up with inflation for 25 to 30 years, let's put it into perspective, from 65 to 90 and beyond, you should start with an income drawdown of no more than 4% to 5% of the value of your capital. Now again, let's put it into perspective. For every 2 million rand that you have in your retirement fund by the time you reach retirement, so for every 2 million rand, you can draw 100,000 rand for the year. Okay? That's 8,300 rands per month, and then you're at the 5% of the income drawdown level, and you are within the rule of thumb. Now, this is the income drawdowns that we're seeing on our platform. Now, don't worry, this is not starting incomes. This is very much higher than 3 or 4%. But it makes the point that if you understand that, even though there's some clients here that has been invested in a living annuity for 20 years, you can see there's not a lot of clients at the lower end of the 3 or the 4%. Okay, that's the first thing. The second thing, which is actually the point of the slide, is I've excluded clients drawing less than 3% and clients drawing more than 17%. With that said, the average income there is in the region of about 7%. We'll get back to that number shortly. Now let's delve a little bit deeper. Now I've taken those same clients and now I've spread them on the horizontal axis according to age, and on the vertical according to the income drawdown that they're taking. Now, the size of the bubbles there represents how many clients are in each of these cohorts. Now, let's focus on one of those cohorts, and that is the cohort of clients that's 65 years old, and that is drawing a 5% income from their living annuity. If you take a client from that cohort, if he starts his living annuity today in that cohort, he is the poster child for the rule of thumb. He's doing exactly what he should be doing. Now, I want to focus your attention. I'm going to give it a last shot. No, the laser is still not working. But there at the 10% level, you can see that the bubbles are larger than the others in that area. It's disproportionate in size. And on deeper analysis, you can see that if you look closely to the percentages clients are taking, everywhere it's scattered. There's a lot of clients at 9.8, 9.9, and then at 10%, it's just skyrockets, and then 10.1, 10.2, telling you that clients just sometimes take let's take 10%. It should work. Not understanding that they're taking double the income that they should be taking, and not nearly understanding the consequences of doing this that we're going to be delving deeper into. Okay? So I want to today look at the mechanics behind the rule of thumb, and I want to show you some ways which you can use the rule of thumb to stretch your retirement income. And I'm going to use the client from this cohort there, and I'm going to focus my first example on the slide, and this is what we're looking at. Okay, so again, I'm using 2 million Rand here because it's easy for me. I can say when I split it eventually 1 million Rand, 1 million Rand. You can use any amount, but I'm starting with 2 million Rand for simplicity. And it means that this client is taking every single month 8,300 Rand, and you will see there that I've made an assumption that every year the client assesses that and increases his income by 5%. That's why you're seeing those steps there. Now, in the ideal world, that client in that cohort, this is what he wants. He wants that income that grows, based on my assumption, at 5% every single year. But I made another assumption, and this is just a starting assumption, that this client is going to be drawing or getting a return of 6%. Now, I want to elaborate a little bit on this graphic there. You will see on the left the return legend coming from 15% to 6%. I set it at 6, it's very low, okay? But also there's a bubble there on top of the graph that says 6% and it's color-coded. You'll understand the reasoning for that now. So if 6 is not the answer, what is the answer? And let's have a look. Well, I haven't shown you that 6 isn't the answer. But there you can see, at a 6% return, the client will only get income to his early 80s. So then let me ask the question again. If 6% is not the return, what is the income that you're looking at? And the income that you're looking at is much higher than 6%. You will see there that 7% won't cut it. We need to go over and above 8, and that's actually the magic number there. That number is 8.2% return. Now, let's spend a little bit of time on this. If you pick up your fund fact sheet or your MDD of your balance fund and you see 8.2%, that doesn't mean you're going to make it. Because what you're seeing there is not a net of fee return. Yeah, it's net of fund management fees. But 8.2% that I'm talking about is what the client gets, his IRR. In reality, you probably need a return of about 9 to 9.5% to make this equation work. Now, this is for the client that is doing what we set out. Follow the rule of thumb, and we know people don't do that. Okay, so let's see what happens when the client breaks the rule of thumb and it takes 7%. So you can see that if we increase the required income that the client wants, that 8.2% return is not going to cut it, and the client is going to run out of income, not even at the age of 80. So now, I'm not going to ask you to guess, but what do you think is going to be the resultant return that you need there to maintain this income? I've taken the 5%, I've increased it to 7 by 2%, 8.2, have a look. You can see 8.2, not 9, 10% is not close, 11%, 11.2%. That's the return that you need. Now, not what you need from your fund return, you need probably about 12 to 12.5% from your fund's return to make this work. And not for 1 year, or not for the last 2, 3 years like we've just did. You need that return consecutively for 3 decades maybe. Okay, so it's difficult to achieve. I wouldn't want to be in this situation when I retire. I'm hoping I won't. Okay, but there's 1 or 2 things that I want to mention here. So over the last few years, we've been doing a lot of return analysis on our living annuity book. And we looked at tens of thousands of clients, what their IRRs were. Now, these are clients that is withdrawing various levels of income, although income doesn't really influence IRR that much, but different investment sizes over different periods. Some of them has been invested for 20 years, some of them only for 1 year. Okay, and what we've seen is that the IRRs are not close to that. When I did it about a year or 2 ago, before we had this little run in the market, 8.2 was probably spot on the average IRRs that clients were receiving. And again, these are like tens of thousands of clients using thousands of different unit trust funds on the platform in different combinations with share portfolios, model portfolios. This is the reality. So what we're saying is if you can't get that 11.2% return, what happens when you miss your return target by 1%? And if you miss by only 1%, you are running out of income at the age of 83. If you miss that by 2%, you're running out of income at the age of 80. And if you miss it by 3%, you're running out of income 12 years earlier than you intended to. Now, it all sounds like doom and gloom. It's going to become better. It's going to be more lighthearted as we go along. But that is the reality. Okay, so at the level that is sort of implicitly implied in the rule of thumb, I forgot to say that a few slides ago. The rule of thumb, if you're taking 5%, in the background, in the mechanics, because I said I'm assuming a 5% escalation, implied by that is you need a return of 8.2%. Okay, so 8.2% only takes you that far. Going back to the slide, we started off with a client that's drawing 5%, is 65 years old, and I've shown you the answer there is 8.2%. When I increase that to a client that's drawing 7%, I've shown you that the answer is 11.2%. And I'm now going to go through every single bubble there and tell you what the answer is that they should be getting. I'm just kidding. So we're going to use something that's a little bit more interesting than that, and this is the answer. Now, what you see there is mapped to every one of these cohorts, the required return that they need to have a successful retirement if their goal is to have that income growing at 5% and being maintained till the age of 90. I cut off clients that needs more than 15% return and less than 0% return because very old clients can actually, they don't need a lot of income anymore. They can have losses and still get the income. But I digress. So what you're seeing there is sort of, if you map it back to the color legend or the return legend, what the returns are. Now my pointer isn't working, but you'll see there the client at 65, 1, 2, 3 from the bottom is yellow. And you'll remember that that is the rule of thumb client that needs an 8.2% return. If you look at the return legend, that is just slightly to the right of the middle. Okay. Now, if you follow that picture across, you can see that it's not a straight line. And that is exactly what I've said from the beginning. This is a rule of thumb. It's not a guideline. You can't say to every single client, if you draw 5%, you're fine. Because you can see clients at the age of 55, if they draw as a starting income 5%, they probably need a 10% return net of fees already. It's getting a bit too risky to use that as a rule of thumb. And you will see it increases as you get older. At this point in time, I always start to feel a bit like a weatherman, saying, we've got a high-pressure system there in the north. Here in the southeast, we're looking at a low-pressure system and gale-force winds and scattered thunder showers, etc. I digress. Let me continue. So that is an assumption that I've made, and that is, let me take one step back. every one of us that is going to retire, that's going to use a living annuity, is going to fall eventually into one of these bubbles. We need to realize that. It's not us, it's going to be some of our loved ones. But not everyone is going to use a living annuity when they retire. Some of us will be using a with profits annuity or a life annuity. These are guaranteed annuities. I've done some research on with profits annuities, but not discussing any of that today. I want to quickly touch on life annuities. Only reason why I'm doing this, I know you all understand these things, but I want to align a little bit of the terminology that I don't lose you along the way. So a conventional life annuity pays the income until the day you die. You can add a spouse to that. You can add a guarantee term to that. Normally, people used fixed rate increases, but you have the ability to link your increases to inflation. Of course, you know that. But today, when I speak about a life annuity, I'm going to be referring to a GAP, a guaranteed annuity portfolio. Firstly, it makes it easier for me because I don't have to say living annuity, life annuity, living annuity, life annuity. It confuses me. But you'll understand why I'm referring to the GAP. So in general, if you look at a living annuity, of course, you've got components there. This is what determines your returns, whether you're invested in a balanced fund or a money market, whatever. And then you've got the product, which determines the legislative limits, how much you can withdraw, how many times you can change your income, in this case annually. And those two in combination is the living annuity. Now, again, our terminology thing, and most of you will know this, but not everyone. Where does a hybrid annuity fit in? Okay. Now, a hybrid annuity is a living annuity. Okay, you get hybrid annuities, that's two separate annuities that's paying two income streams. But what I'm referring today, when I'm talking about a hybrid annuity, is I'm saying, like you select components, like a balanced fund, like a property fund, you select a guaranteed annuity within your living annuity as a component, almost as a fund. And that's why I'm saying a GAP, a guaranteed annuity portfolio. Okay, so a hybrid annuity, like I say, it's a living annuity that offers guaranteed annuities as components. Some companies offer with profits annuities. Today I'm going to be referring to the GAP because that's what my research is about. So it's a life annuity. Now my question that I want to answer today is, if this is the rule for a living annuity, what would the rule be for a hybrid annuity? Would it be the same? If you say, I want a hybrid annuity, what would be the income level that you could start off with and still have a safe retirement? Now, to do that, I need to go into the assumptions that I've made. At the time of doing the research, the life annuity that I used was paying 7,400 Rand per million. I selected a 5% escalation. It just ties up with the income escalation level that I selected. I included a guaranteed term of 10 years, and the quote was for a male age 65, done in June. So now we get to what I think is the exciting part. So if you look at that picture again, we have that bubble at the top, dark orange, 11.2%, as indicated on that return legend. You can see the income that the client gets will hold till the age of 90. But now I'm just going to reset this to that income or to that return level as is the return level underlying the rule of thumb, the 8.2. Now, this for me was the first aha moment in the research. Okay, so because I wanted to understand what happens when you start to allocate some of the assets towards a gap, when you use a hybrid annuity. And I'm going to start low at a 1% level, and I'm going to increase it up to 50%. And now the new line there is the hybrid annuity. And look what happens when you allocate towards the gap up to a level of 50%. All right. So now, when I saw this for the first time, I was like, regtig? Could that number 99 not just go up to 100? Did it have to stop there? No, I was kidding. So with a hybrid annuity, with this allocation, and think about a gap now not as a product, think about it as an asset class. You've now taken your funds and you've added a new asset class into the mix, and now all of a sudden, you've got this income certainty. It pays you the full income till the age of 89, but just falls short at the age of 90. Now, this was for a very specific client. Now, what happens when we take all the clients on the living annuity book? Okay. This is how this changes when we allocate gaps based on the rates that the client would get for his age, etc. This was done for male clients. I just want to quickly mention, unfortunately, my laser isn't working, but you'll remember there, the 65-year-old, 1, 2, 3, 4, 5 from the bottom, it's dark orange currently. That means the client needs an 11.2% return. But you've seen now, as I'm allocating to the gap, I've just shown in the previous slide, if I go back one slide, that we can solve this equation basically using an 8.2% market return. So look at what happens to the return that you need as a client when you're allocating. Oh, great, thank you. As you're allocating, let me just make sure I know how to use this. Still not working. Oh, yes, probably just do 4. Okay. No, this one isn't working. That one you can't see, this one isn't working. But in any case, so as I allocate more towards the gap, look at how this picture changes. And you can see that as we allocate, a lot of the book is turning to dark green. And if you want anything, you want a dark green return to, you want low returns to still get a successful retirement. And you can see here, by allocating more towards the gap, we really have the ability to change the income certainty that clients will have. There's two things that I want to mention at this point. So the first thing is, certain clients are just taking too much income. This is not a solution that is going to change anything really for them. The only thing that's going to change is they might still have income in the latter years, but the income is not going to be sufficient, but it's better than nothing. But on the bottom half, we really, we can change, or hybrid annuity can give a much more secured returns to clients. But I want to show you something else that was very interesting to me. If you follow that yellow line, and at the age of 65, it's currently set at 5%. Okay, so 65, there's 1, 2, 3 from the bottom. That color is yellow. Now, don't look at the green, look at the yellow, and look at the level of the yellow as we allocate more towards the gap. Oh, no, 1 second. Do nothing yet. Right, so you can see how it's starting to increase. Now, the point that this makes is that the starting income level for a hybrid annuity and for a living annuity is not at the same level. Okay, the starting income that you can take as a client and still have a safe retirement is higher for a hybrid annuity. But at what cost? As Warren Buffett says, it's not Warren's quote, but he often repeated it. In investments, there's no such thing as a free lunch. And let's have a look at what happens to inheritance. Now, what I've done now is I've moved from income, I've moved to market value. What you're seeing there is the living annuities market value under the return assumption of 8.2. It's slightly a conservative assumption, but yes. So as I allocate towards the gap now, and when I get to 50%, I want to state the obvious. What is going to happen is the gap there at the very beginning at the age of 65 is going to grow by R1 million. Okay, because a life annuity doesn't give an inheritance value. And for me, that was always like, hybrid annuity, it's got this benefit, gives you secure income, but you suffer on the inheritance side. For me, this was the second aha moment. So look at what happens firstly to the income at the bottom. There on the left, nothing is going to happen with the first 16%. That is what you get from the living annuity, and it's not going to change as I allocate to the hybrid. But the second 16 is going to start to increase, and at a certain point when that number becomes significant, something interesting is going to happen on the inheritance value. Let's have a look. So as I allocate more towards the gap, you see that gap opening at the beginning, or that shortfall, let's not call it a gap, opening at the beginning, at $1 million, and now as the income starts to increase, all of a sudden the inheritance value of the gap becomes significantly higher than that of the pure living annuity. There's actually a crossover point there at the age of 79. It's not always going to be the crossover point. It's going to be dependent on rates, the return assumptions that you use, but it's much, yeah, I did not see that happening, or that wasn't my initial idea. Now, for those of you with a sharp eye, you will remember that in my assumptions, I used a guaranteed term. Now, a guaranteed term does change this picture a bit. I haven't shown it to you yet. But a guaranteed term is basically, if a client dies 1 year into the investment, the remaining 9 years is commuted and paid into the living annuity. And therefore, you'll actually see this hump in the first 9 years or 10 years. So that is actually the inheritance value from the hybrid annuity. So it's not such a big shortfall, and you can, of course, you can play with this guaranteed term. The longer you make it, the less of the shortfall up front, but you do give up some of the gains in the long run. Okay? And then lastly, one thing that I just want to touch upon, and I see I'm in time. One last thing that I want to touch upon is, this is now, of course, under a certain return assumption of 8.2. If we raise the return assumption by 1.5%, just to keep the graph in the screen, you can see there that your crossover point moves a little bit to the right, but the hybrid annuity still in the long run has the ability to give a better inheritance value. At one point, if you keep on increasing the return, of course, the living annuity is going to look better on all fronts. That is just the reality. But when markets are doing so-so or badly, the hybrid annuity brings another dynamic to a client. Now, there's more to, if we actually wanted to quote the retirement income rule for hybrid annuities, there's one other aspect that I haven't covered yet. And I would state it slightly differently. I would say the following. If you want a hybrid annuity income that lasts and keeps up with low inflation for 25 to 30 years, and the remainder of it. Because a fixed annuity is obviously not going to give you any protection against inflation. Okay, but there's ways and means. You can, instead of using a fixed annuity, you can use an inflation-linked annuity. And you can counteract that risk. So far we've counteracted longevity risk, market risk, but not inflation risk. We have new research that is going to be published soon. I don't want to share everything with you today. I want you to follow us on LinkedIn and to see this for yourself. We're going to be releasing a lot more information on this and other things that I haven't spoken about today. So get onto LinkedIn and have a look at it. But let's get to the last session of my presentation. So now we're going to be talking a little bit about a different concept. One of my colleagues, Paul Nixon, did this work. I'm just presenting on it because the last part of it is something that we worked on jointly. So he coined the phrase or the word behavior tax. Many people talk about a behavioral cost. He speaks about a behavioral tax, and what is it? So I firstly just want to mention something, that there's a saying that data is the new oil. Now, why was the word oil used? Why wasn't it data is the new gold, or data is like the new diamonds? So it is because data unrefined, like oil that is unrefined, is basically worthless. It is in the refining process that oil becomes valuable, and it's also in the refining process that data becomes valuable. Now, the behavior tax is all about looking at switching behavior of what is about 150,000 different switches, and understanding what is driving switching behavior and what is the actual cost of switching behavior. Now, let me explain to you. This is an actual client that invested in 2024, or invested and he did a switch in 2024. And at that point in time, for whatever reason, I expect it's because he had underperformance, but I can only speculate. this client switched, and of course, the switch was into a very conservative fund. You can see the straight line performance there. Might have been looking at a fund fact sheet and saying, oh, this is doing 8%, what am I getting? Now, the question is, what would have happened if the client did nothing? Now, this client, if he hadn't done anything, this would have been his return. So you can see in the first 3 months, there's actually a, let's call it a behavioral return. He would have been better off, but eventually he is paying what we call a behavior tax. He's not paying it to start, he's just not getting the returns that he would have received had he done nothing. Now, do know that a behavior tax doesn't mean that you had a negative return. You can still have a positive return, but you had a lesser return than what you would have had if you had done nothing. Okay. So looking at all the switching behavior of the 150,000 clients, these are some of the insights that we've gained. In the 2024 cycle, there was about 60 million rands of value destroyed on our living annuity book and on our LISP investments. That is not the entire book, that is just 2 of the products in play. 60 million rands destroyed. In the living annuities, the value that was destroyed per switch, it is annualized, but it's in the region of about 4.3%. And in part, why did this happen? Because the clients switched from unpopular funds to something else, and those funds did 14% better in the subsequent year. So if they just resisted that switch each, they would have been much better off. Now, there's a different part of an analysis that I'm not gonna speak about or have slides on, and it is to understand what drives switching behavior. And firstly, I just want to point out, you'll see that the living annuity is in all 3 of those blocks up there. Now, what Paul and team did is they used a random forest model and they ran all the data through this. And this supervised machine learning algorithm then looked at all the factors on this investment and it ranked it according to which of these factors are actually the best at predicting switching behavior. And 2 of the factors that ranked very high was, in fact, size of the investment and age of the investor. Now, going back to living annuities, now you understand why living annuities is such a big, the key factors are coming from living annuities because these are all the clients with high valued investments. Okay, so now, going back to this part of the analysis, the next question is, does every client who switch exhibit the same investor behavior? Are they doing it for the same reasons? Now, I always get confused and then I have to look at the picture and then I see those red dots there and then I make the connection. The red dots, think about the Terminator, that red eyes. So this is an unsupervised learning model like the Terminator. Okay, so the algorithm actually is a clustering algorithm that was used, and what it does, it looks at all the different switches and then it clusters the client. It puts them into groupings. But you don't tell the model, please put them into 4 groupings or put them into, the model decides. And that's why it's unsupervised. And in this instance, the model came up with 4 different clusters. And these clusters have holds clients, and these clients exhibit similar switching behavior. And Paul called these clusters or archetypes the avoiders, the anxious investors, assertive investors, and market timers. Now, the avoiders are clients that don't like to take on risk. When they do switches, they switch from conservative funds to conservative funds. It's a low-risk switch, if I can call it that, and they pay the lowest behavior tax of all the archetypes. If you look at the anxious investors, my previous example on behavior tax is probably spot on. I can't say that was an avoider, but it looks like one, because when markets are an anxious investor, when markets have fallen, instead of waiting for the recovery, they switch out just to miss the recovery. Then you've got the assertive investor. They are the performance chasers. And then lastly, you get the market timers. They suffer from the worst attributes of the anxious and the assertive investors, and they are predictably irrational In fact, in their living annuities, they paid very close to a 6% behaviour tax through the switches that they've made. Now, Paul and team is going to be releasing the new sci-fi report, as they call it, soon. You can actually Google now if you want to the Momentum Sci-Fi report. It will give you the one from last year. But I think before the end of the year, probably in November, the new one will be available. The results over the years were as follows. You can see the average client in those cohorts were paying behaviour tax in all years except in 2022, where it was only the assertive investors that was paying a behaviour tax. All right, so I'm going to leave the behaviour tax section here, and I'm going to move to the final part of the presentation that is trying to sort of link these two things. We've spoken about a hybrid annuity. We've spoken about behaviour tax. Now, what is the effect of behaviour tax if a client is invested into a hybrid annuity? That's what we try to answer. Now, this was exploratory research. When you hear that you have this chance to come and present in June, you need to get starting. And we didn't know what the results would be, but I want to ask you, show of hands again, who of you think that clients in a hybrid annuity will pay lower behaviour tax? That was my expectation as well. Okay, so now when we started the analysis, we knew that the hybrid annuity has been in existence for 41 months. That was in June. And then we approached Paul and team and we said, we're going to do some adaptations to your behaviour tax model because we want to classify clients. We wanted to know these clients are living annuity clients, these clients are hybrid annuity clients. And we did that, but we had to go back by about 2 years because the new report is going to be released now. The old report was released a year ago. And we wanted to make sure that clients are hybrid annuities before entering into the study. So it ended up that our base was much smaller than anticipated. We only, that was basically the clients had to be in a hybrid annuity 15 months after the launch of the product. So we knew, okay, our data set is small. But if the results are very positive, then we would say we found something. Okay, so how do you know that you have been paying or improving behaviour tax? The first thing that I thought of was, okay, so every time that a client does a switch, the switch is causing less behaviour tax. That was my first initial thinking. And then he said, no, there's 3 ways in which you can improve behaviour tax. Firstly, the nominal amounts of the switches are smaller. Then secondly, when a client does a switch, the switch is causing less behaviour tax. But thirdly, and this is the one that I think is what we're aiming for. Sorry, I hope you're awake now. What you're aiming for is that people do less switches because they sit and they're like, I'm on track. I can stay calm. I don't have to make any changes. And unfortunately, our results was marginal on the second 2. Okay, so we are not really seeing what we're wanting to, but I want to say yet. I'm hoping that in a year from now or with the next release of the sci-fi report, when we start to do the analysis, we might be able to see some trends. I know for a fact that the next report will have 3.5 times the amount of clients in the report already, so it's a much better data set. And I'm hoping that we can start to see conclusive evidence whether it does or whether it doesn't change behaviour tax. And then lastly, some of the things we looked at in the data is just to see, how many brokers were there that did switches, because these are the early adopters of the product. And we found that, a lot of the switches were actually done by very few advisors. So, it's a little bit too focused group to really get results. So even though the cluster proportions of the archetypes changed a lot, I don't think we should read too much into it, but we're going to keep our eye on it. I want to end off my session today, before we go into Q&A, just with some of the future thinking that we have in terms of this research. One of the things that I've asked Paul and team to do is to bring another indicator into their random forest model to flag these annuities, whether they are living annuities or hybrid annuities, so that if they do their predictive switch model or they do the work on it, that can, potentially say that, it's not just size, it's not just age, but it's also whether the client has a living annuity or a hybrid annuity that determines whether a client will do switches or not. It's one of the things we're looking at. And also, doing some research into investor personalities to better understand, which clients are in need of safety in their investments, which clients are too over-optimistic when they see markets running, and sort of to try and tackle that personality traits with investor behavior. So with that, I'm going to open up the floor and, just one last quote. You can read it for yourself.
Thank you very much, Martins. We now are going to enter a time of questions. So if you do have a question, please can I ask you to raise your hand and the roving mics will come and find you. Okay, I see a few. Can we start here in front? And then there's a couple of gentlemen in the back. Have you already got a mic there at the back? Do you want to maybe start and then we'll bring some mics forward? Thank you.
Thank you. Thanks very much for the interesting piece of research. More comment than a question. Sorry, back here. Just on the last point around the switches, maybe a more cynical view is we're likely to see more or as many switches, even in a hybrid annuity world, with a bigger sample because of the advice component. And if the hybrid annuity is bringing more certainty to income, maybe your advisor tries to show value add and earning the advice fee by doing more switches. So just something to bear in mind. Thank you.
Very valid point. Totally in agreement. And I just want to mention something. If there's very difficult questions here, I brought the team Faria and you must be.
All right, let's take this one in front.
Thanks, Martin. It's great. I think it's so useful for this research to become available so that investors can start changing behavior. You did the research in June and interest rates have come down. Value in that gap has reduced quite a bit. Did you look at the sensitivity to that starting pension from the or the life annuity?
So very true that rates have fallen quite significantly. My first thing that I wanted to determine is, and I'm now just talking hybrid annuity on its own, is when, if the rates fell, up to when could a client still have said, you know what, I want a higher income rate, so I'm willing to sort of take a lesser guaranteed terms to still get that 7,400 rands worth of income. And sort of till middle September, that was still viable. At this point in time, rates have decreased a bit. So it is true. Unfortunately, I can't bring everything in time into the paper. One thing I do want to mention is the opposite. Is that in 2023, when was the local or the elections? It was 2024, I think, yeah. So at that point in time, rates were extremely high. If I remember the graphs, it was probably the highest it's been in 20 years. And the results at that point in time would have been staggering. I think that bubble chart, if I can call it that, would probably have gone up even further in terms of how much you can actually increase your starting income by. I don't know if your question also related to the behavior tax, if there's something I need to connect there as well.
No, it's only that one, but I think it would be very useful for, people don't keep an eye on that annuities, and I think the hybrid gives a fantastic opportunity for somebody to, at the right time, switch more into the gap. And I think that's something that could be a very useful indicator for advisors to know, okay, this is now the time we could start moving into a guarantee rather than riding the market. Sort of like some of the products have a structured change, switch into gaps just at the time when the interest rates are for good value.
Yeah, no, it's very true.
Any other questions? Let's See one there. If you do have a question, please just keep your arm raised so that we can get a mic to you. There's a gentleman here in the front in red.
No, thanks for the presentation. So the question is around the switching component on the first part of the presentation. So I noticed that you basically have the hybrid, where you have the living annuity and both the life annuity. Would it make any difference if you were basically to have a deferred life annuity and the first component is purely a living annuity, because it would basically, reduce the whole risk around inheritance and things like that, allow the member to build a higher, basically, pool of funds, all things being equal, and then switch into a life annuity at the end at cheaper rates and possibly a higher income at that point.
Okay, so I'm going to answer the question as I heard it. I'm sort of in between two. What you're asking could mean one of two things. Let me start off with what I understood from the question is, should I invest in a living annuity now and, say all else being equal, rates don't change, rates stay exactly where they are, you just get a higher rate because you get older, and defer that till the age of 70. Okay. Now there was a piece done by Behaviour and Swanepoel, I can't remember all the names exactly now, and it basically showed that there's value in buying a life annuity earlier. Okay, because you're putting your capital at risk, and because of that, there's like a sort of an inherent profit in that. You get a better outcome by doing it now, but instead of deferring it. There's value in that. I also did a piece on that in 2022, where I did the exact same analysis. I'm not sure if that paper will still be available, where we spoke about something that was called an outcomes map at that point in time. And we did the same research and we said, does the potential to do that become higher if you wait, or is it a situation where if you wait, you might get to a situation where you can't buy that annuity anymore? And it sort of alluded to that rather do it earlier than later, with all else being equal. I hope that answered your question. Thank you. Yeah?
There's a gentleman here in a checkered shirt, and then another gentleman at the back there, but let's take the gentleman in red first.
Thanks a lot, Neville from Jamaica. You mentioned rule of thumb, and it was very enjoyable to see that they up to 50% up and down, and the colours are good. But what would the rule of thumb be at 65 on the hybrid? Is the kind of rule of thumb 50% living, 50% home? Life seems to be a reasonable rule of thumb. Because it could be interesting, is that a better option than 25 or 75% life? It'd be interesting just to know that rule of thumb. And the other idea of deferring, if you start at 100% living, what would be the rule of thumb at 65, at 70 or 75? What could the rule of thumb be? It could be interesting, given the markets, to see.
Yeah. So, Neville, thank you. I love your question, by the way. So, if you take the hybrid annuity at the time of doing the research, and with the assumption that inflation is going to remain at 5%, how the rule of thumb changes determines on how much you allocate to the life annuity. And because in my example, if I allocated more to the gap, if I allocated more to the gap, it would have probably increased a bit more. But because I allocated to the gap, it increased from 4.5 to about 6-7%, increased by about 2%. That is very rate dependent. It's going to change over time. That's why I try to steer away on this presentation, is to say that, the new rule of thumb is now 6 to 7%. But what is for me more important than that is, at the end of the day, it's not up to us as actuaries to stand here and to say to clients, put 50% into the gap, or put 30% into the gap, or 70% into the gap. what is the context? What's the advice context? What is it that the client needs at the end of the day? We didn't showcase it here, but we've got something that's called an income illustrator, where a client can actually input his need. And he can say, I want a starting income of 7%, but with an escalation pattern of 3%. And then instead of me saying to you what's the answer here, or a financial advisor telling you that the answer is 30% rule of thumb, the tool actually does like an asset allocation optimization process to get to the result to say, you know what, you should be using a 40% gap with a 5% escalation or 50% gap with 0 escalation.
Sounds great.
Please, can I have the mic taken to the man in blue at the back? But man in the checkered shirt, would you like to ask your question?
Thank you. This side. Sorry.
Oh, also.
Was the behavior tax always a 12-month assessment?
Yes.
And then was there no good cluster? How many clusters do you need to find a good cluster?
Now, look, let the cat out of the bag. In 2022, of the 4 archetypes, on average, only the assertive investors paid behavior tax on average. The other 3 actually had a positive impact because of their switch. It's a great thing because it shows that sometimes you win, sometimes you lose. Sort of indications are this year around when the SAFA report is about to be released, we're not going to see 4 clusters paying behavior tax again. There's going to be less of them, but I'm also waiting for that research.
But you're 4 out of 5. What about a contrarian fund? Why don't you start with?
Okay, look, it's not the fund. It's more on the investor and what the investor is doing, independent of which fund they are invested in. But good.
At the back there.
Previous question, just I thought about it's a question about a deferred life annuity. Because I know the legislation in South Africa doesn't allow that yet, as I understand. I'm not on pensions actually, that you can't increase your income by more than 20%. So a pure deferred life annuity. So you buy it at age 60, it starts paying at age 80.
Yeah.
Wouldn't that fit better? Isn't it time that we lobby the regulator to allow deferred annuities, because they do have a space in the living annuity. If you can cover your income, you apply 25% of your capital at age 65 and buy an annuity that provides you with a level of income plus increase from 80 onwards. Then it takes so much risk out of the system as well. That's what you're trying to do with the hybrid annuity, but that's just more doing it on a more pure basis.
Yeah.
Because you're physically covering that risk at the end, which you want trying to solve. And I think there must be put more pressure on the regulator to make that available to the industry, because I think there's a big need. If the insurers are willing to take the risk, I know it's a high risk product for them, but there's ways and means to do that.
Yeah, I want to tell you 2 things, or my opinion about 2 things, is I'm always thinking about what if you have a guaranteed annuity that is sort of escalating at a certain level up to your life expectancy and then changing thereafter. If that's set out up front, it could actually be something where it's very, market-linked exposure and just your annuity income guarantee taking over in the long run. That could also be something interesting to think about. The deferred annuity I think it can work. What I like about not doing that is the value that you get from a gap. If you put it into an IRR perspective, it's not you have 0 value and now all of a sudden you've got great value. It's like if you take all the payments and you just take it to that point as if the client died at this point, you see that it starts off negative, especially if you didn't add in a guaranteed term, and then after about rate dependence about 8 years, 9 years, it starts to become positive. Then it sort of just levels out depending on where the rates are, whether it's 14, 15 or 13, 12%. But the client always gets value from the gap because he's been getting income payments throughout. It's not as if you have to, only pay from 20 years onwards to protect yourself against longevity. By having this product, you're actually getting longevity protection from the beginning because your market-linked assets don't have to work that hard because your income payments are partially funded through this gap throughout. So yeah, that's my opinion. But, lobbying the regulator might be a good idea.
We have time for one question. I see there's a gentleman at the back. Go for it.
It's Ryan from Saveka. Just a quick question and more of a comment. Who did your slides? Because the presentation was actually really, 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 really good. To actually follow them, it's not just standard technical actual slides. So who did them?
Thank you. All right. I'll catch you afterwards.
Any last questions? Okay, we have one more question. Go for it.
Thanks, Martin. It's Nick Gibbs from Robson Savage. The analysis of the behaviour tax investors, is there split by who has a financial advisor and who doesn't? In other words, is there a financial advisor tax there?
It's a very relevant question. Look, for that one, I'm going to ask you, Paul Nixon, to reach out to him. I know he has approached certain financial advisors to say, let me calculate your client base, their behaviour tax, because that could potentially lead you to, or help you to understand the value that you are bringing to the equation and whether you are reducing behaviour tax or whether your client's behaviour tax is the same than anyone else, or perhaps even higher. So I don't have the exact answer, but I know there's thinking in that regard to help financial advisors to be better sort of behavioural coaches, and not just people that, selling products and making budgets, but to get that behavioural, psychological aspect into planning.
Thank you for your questions, and thanks, Martins, for your presentation and your beautiful slides. We now are heading into a 15-minute transfer time, so please make your way to the next session that you want to attend. Just noting that if the doors are closed, please just wait for the previous session to wrap up. Thank you very much.